If you are a creator in the United States, listen up. Your entire tax world is on the brink of a massive shift. So today, we are breaking down the brand new 2026 tax code. Our goal? To show you exactly how to legally and strategically slash your tax bill and keep way more of the money you earn.
Let's just start with the single most important number you're going to see, 15.3%. Now, this isn't your income tax. No, this is the hidden self-employment tax, and it hits every single dollar you earn as a creator. It is absolutely relentless. And see, that's the real problem, isn't it? Most creators are running their finances on an old playbook. Look, key parts of the Tax Cuts and Jobs Act are expiring in 2026, and that means the entire game is changing. Sticking to your old tax strategy isn't just kind of inefficient anymore, it's a direct financial risk. You're leaving thousands of dollars on the table.
All right, so for this briefing, I'm going to be your technician. We're talking pure math, pure tax code, and I'll be your skeptic. I'm going to be asking the tough questions about the real-world costs, the risks, the headaches. All right, let's dive in.
Okay, Section 1. We have to frame this correctly. That 15.3% self-employment tax, that is your primary financial enemy. Our entire strategy for the next few minutes is built around one single goal: legally and strategically crushing this tax.
This right here, this isn't just a suggestion. It's a blunt fact. If your business is netting over $60,000 a year, operating as a sole proprietor is a flat-out, undeniable mathematical mistake.
Which brings us to the single most powerful weapon you have in your arsenal to fight that 15.3% tax, the S-Corporation. For any creator clearing that $60,000 mark, this isn't just some good idea. No, this is the very core of a logical tax strategy.
So here's where the magic happens. It's all about how an S-Corp lets you split your income. Just look at this table. As a sole prop or a standard LLC, 100% of your profits get slammed by that 15.3% tax. But with an S-Corp, you pay yourself a reasonable salary, and yeah, that part gets taxed, but the rest of the profit, it comes to you as a distribution, which is not subject to that tax.
Okay, hold on. This already sounds complicated. Are we talking about hiring expensive lawyers and drowning in extra paperwork? Come on, what are the hidden fees here? What's the catch?
That is a fair question, but let the math give you the answer. Let's say you earn $100,000. By paying yourself a totally reasonable $60,000 salary and taking the other $40,000 as a distribution, you instantly avoid paying that 15.3% tax on that $40,000. That is a direct savings of over $6,000 every single year. I mean, that's a brand new camera paid for just by having a smarter tax structure.
So the logical bottom line is this. Yeah, okay, there's a little more complexity, there's some administrative cost, but for a $6,000 annual savings, that's not an option. That's a financial necessity. It is an absolute no-brainer.
Okay, we've optimized our structure. Now it's time to go on offense. The 2026 rules have seriously expanded what counts as a legit business expense, and we need to use these, what I call weapons-grade deductions, to their absolute full potential.
All right, let's run through the big three. First, the home office deduction using the simplified method is so easy. It's literally just $5 per square foot. Second, Section 179 lets you deduct the full cost of your gear, your cameras, your laptops, your lights, the same year you buy it. And yes, all of your software subscriptions are deductible.
Wait a minute, for real? You're telling me I can actually write off my ChatGPT Plus and my Adobe Creative Cloud subscriptions as a legit business expense? The IRS is cool with that?
Absolutely. If it's ordinary and necessary for your business, it counts. And check this out. This is a surprising new one for 2026. It's a no tax on tips rule. It allows you to write off up to $25,000 in tips, or what they call performance bonuses. It's a huge new benefit that almost nobody is talking about yet. Okay, so the logical bottom line here seems pretty simple. This isn't about trying to find some sketchy gray area loopholes.
Exactly. It's about meticulously, obsessively tracking every single legitimate expense. Proactive tracking isn't optional for a smart creator. It's non-negotiable.
All right, we've played offense. Now let's talk defense. The goal here is simple: to build an impenetrable shield against those costly, totally unnecessary IRS penalties. And this, right here, is where everybody gets so frustrated. The IRS says you have to pay quarterly taxes if you think you're going to owe more than $1,000. But why? Why can't I just settle the bill once a year in April like a normal person? It just feels like such a chore. It's because the U.S. has a pay-as-you-go system, but you don't have to guess what you'll owe. There is a simple, beautiful formula to make yourself penalty-proof. It's called the Safe Harbor Rule. It's so easy. Step 1, take 100% of last year's total tax bill. Step 2, divide that number by 4. Step 3, pay that amount each quarter. That's it. Even if you make 10 times more money this year, the IRS cannot penalize you for underpayment. You are protected.
So the logical bottom line is you have to reframe how you think about this. Quarterly taxes aren't a chore, they are a strategic defense.
Exactly. You should treat it like a castle defense. Following the Safe Harbor Rule is like building an impenetrable wall around your finances. It is your shield.
Okay, let's put it all together into a plan you can actually use. This final section is your logical action plan. Simple, practical steps you can start taking, like today.
This might be the most practical tip of this entire briefing. It's the 30% rule. Every single time you get paid, from a brand deal, from YouTube, whatever, before you do anything else, automatically transfer 30% of it into a separate high-yield savings account. Now, this isn't just about discipline. This is about making your tax money earn interest for you before you ever have to hand it over to the IRS.
And that really gets to the core message here. Taxes feel like this big, scary bill that you just have to suck it up and accept. But they're not. I love this quote. Taxes aren't a bill you just accept, they are a mathematical puzzle you can solve. And with the right structure and strategy, it's a puzzle you can absolutely win.
So, what's your first move? Simple. We put together a one-page creator tax checklist for 2026. It summarizes everything we just talked about. The link to download the free PDF is right there in the description. Make that your immediate next step.
We've just handed you the logical framework to completely optimize your taxes. Do this, and you will keep thousands more of your own money. Your tax strategy is now officially set for 2026. But is your investment strategy ready for what comes next? Well, that's the next puzzle we all have to solve. Thanks for tuning in.